Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Thanks for being with us. Well, today we're talking about the U.S. office market, and we're looking at tenant strategies, landlord strategies, investor strategies. And please welcome my next guest, Jim Bacchetta. Jim is VP with Highwoods Properties. Jim, thanks for joining us here in Studio One today.
Thanks, Michael. Fun to be with you.
Well, we appreciate you having you here. You're always insightful. You guys handle a lot of real estate around the U.S., and you get to see from the ground level what's going on. And that's my first question for you. As an owner, as an operator, what are you seeing for performance on some of the properties in some of the areas you have around the country?
In our 10 markets, we're seeing steady growth, steady occupancy gains, not only in the markets we're in, but in our portfolio. We're seeing good rent growth really across the board. And it's probably best summarized as 10% rate growth on average over the past 2 years, so say 5 and 5 on face rates, and I would say that our effective rates are up better than that, maybe pushing close to 15, because concessions are down and tenant improvement packages are a little bit less. So our effective rates are, you could probably say across the board, maybe 10 to 15% better, and we see that trend continuing.
That's pretty amazing. I mean, have you seen that kind of growth before in your history? I mean, that seems pretty high.
If things are better now than they've been in quite a long time. I mean, we have seen this kind of growth, but you don't see this kind of growth often. And it's a function of supply and demand. Econ 101, supply and demand, and it's a function of dwindling supply and steady demand. The demand's not robust, but it's steady in all of our markets. And job creation is happening. Office space absorbing job creation is happening in virtually all of our markets, so that's a good thing.
Yeah, that's strong. I mean, the increase in jobs really helps the office market, doesn't it? So, but you've also hear about tenants and companies reducing the amount of square footage. That people are working from home and they're sharing desk. What are you experiencing there? I mean, you're getting more occupancy, but are some of these tenants using less space?
Yeah, some are.
Yeah.
But there are a lot of factors. It's an interesting question. There's a complicated answer for it, but every market is different. Some markets you just simply cannot get more dense. Like you take a market that doesn't have any extra parking outside and maybe doesn't have good rail service. Those markets, you can only get so many people in the building because the parking facilities will only handle whatever is zoned. A lot of our markets are zoned for 2.5 to 3 per 1,000 parking in the building itself. And if you do not have outside parking, and if you're not rail served, you're not going to get density up. And some markets are like that. So in those markets, we're not seeing the densification. And some of those markets are a little lower price per square foot. So users are not as focused on densification in some of those markets. But in urban markets where there may be on rail and you have perhaps some outside surface parking, you can get your density up, and in those markets where it's feasible, a lot of employers, a lot of users are looking for more density.
Well, that's interesting because I think a lot of our listeners are in these major gateway markets, so maybe they are experiencing more dense use of office space. But obviously we have listeners all over the country that maybe in some smaller markets. So what you're just saying there is they may not be seeing that issue because you just don't have the capacity and the parking and that sort of thing.
It's not feasible in some markets, but you also have a certain tenant or user type that really is probably not going to densify very much. A lot of law firms, the partners still want their offices. Their associates, they may be in workstations, but you're trying to recruit and compete against other law firms, and you're just not going to shove people into small cubes. And so it depends on the type of tenant, but we're not seeing as much densification as you hear about. We're seeing some of it, and one of the trends you see is there may be in some instances a little bit less me space, but more we space to compensate. So the big collaborative areas that people like to get together and have meetings and discussions and kind of cool out. We're seeing nice break rooms and so they're all those factors come together, and yeah, there is a little bit of densification, but I think what you hear, it's a little overhyped.
Okay. Well, that's interesting. You talk about recruiting and keeping your employees in-house. And that's one of the things that we've done is we have some private offices, and a lot of our competitors don't have private offices, and they're in cubes. So, I think some businesses are going to benefit from that if they want to go ahead and pay and keep some of these private offices. It's also interesting, the millennials, are they going to be okay in these cubes, or when they start being more executive paid folks, are they going to want private offices? Where are we headed?
Yeah, I think depending on the industry, I think it's important that you certain people in certain positions, they just have to have a private office. You need a private office if you've got an issue with an employee, you got to pull them aside and talk to them, and there's always going to be a demand for private offices, and everybody's not going open office crazy.
Yeah, that's interesting. Well, no, I have a private office. They stick me in the broom closet right here.
Right. Well, when you're the CEO of a company, you have to wear a lot of hats. Right? You get up,
right.
You make coffee in the morning, and then if you have to clean up, you tidy up. Right, do whatever you have to do.
That's right. Well, I want to ask you too about, is it time to build? If the market's that robust, is it time to build?
We're building in a couple of our markets, but most of them still have there's still a premium required to support new development costs above the market rates. So as we see rent growth approach the cost, or that you have to come out of the ground and pay X amount of dollars for a building, you got to get a certain yield on that as a developer, and you just are. It's going to take a little more time in the market for us to see a lot of construction. I think we're going to see some more run up in rents before we're going to see a lot of development.
Well, good. I want to hear some more about that and about the investment market. We'll look at cap rates. Stay tuned. We'll have more. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back.
The Commercial Real Estate Show is brought to you in part by RealNex, providing a comprehensive suite of powerful commercial real estate tools at an incredibly low cost. Visit realnex.com. That's REALNEX.
Welcome back. I'm Michael Bull, and this is the Commercial Real Estate Show. Today we're talking about the office market. My guest is Jim Bacchetta. He is with Highwoods Properties, and they own a lot of office properties. And Jim, the investment market for office properties around the U.S. has gotten hot. Some would say it's a little frothy. What are you seeing out there for the investment sales arena?
It's hotter than it's been in this cycle. It's really, really hot. Frothy is a good word to describe it. If you're a seller, it's terrific. If you're a buyer, it's very frustrating. It's challenging. Everybody's trying to buy good quality trophy assets, and we are. We sold, most of our non-core assets, in the last cycle, at the end of the last cycle. Fortunately for us, good timing. But we're buyers, and our chief investment officer, Ted Klink's pulling his hair out. It's just very, very tough. Cap rates are low. There's great competition, and it's tough if you're trying to acquire.
Yeah. What are you seeing for some sample cap rates on some of the properties that you guys are going after?
Oh, well, you see, plenty of sub-7 stuff. You're seeing where, of course, in the office market, we're seeing different rates for different product, but we're chasing, the best assets in the best markets, and so, well under 7.
Yeah. Okay. And what do you expect moving forward into 2015? You think the office markets continue to improve, and you think the investors are still going to be hot after office properties, or is there going to be any impact from what we expect to see some rising interest rates, right?
Well, I think demand for good quality office buildings will continue. We aren't seeing a lot of new supply, as we talked about a minute ago, so I think we're going to continue to see rent growth, and we're underwriting increases in rent, and everybody is, because it's inevitable. Supply and demand is going to drive that. And so I think we're really going to see cap rates stay low for a long time. And if interest rates rise, could have some effect. Probably won't have a real big effect, because most of the big buyers aren't as tied to interest rates. Like we're a real estate investment trust, and we're low leverage. And so rate doesn't have that much of an impact on our cost of capital. It has an impact, so there may be some leveling off of cap
Okay.
rates.
And you talked about you really have to have some great rent growth and occupancy growth in these markets to build. You are building somewhere. What are you seeing for construction costs, and how's that impacting new supply levels?
Construction costs are rising everywhere. Materials, labor, it's just getting more and more difficult to pencil these new development opportunities. So that's why we're only doing a couple of them, and we're typically the only thing we're doing is build to suits because and there are some markets where no large blocks exist. So a new user in the market is going to require new construction, and those are good opportunities for build to suits. But we're seeing cost per square foot approaching $400. Particularly in the urban markets where there may be some logistical challenges. In the suburban markets, in which we're really not in, you're closer to probably low 300s. But
And that's all inclusive. So that's your soft cost, land, everything.
yeah,
Okay.
and that would be structured parking included in that
Structured parking, yeah.
number that's pushing $400.
But that's not cost to stabilize the asset, right? Or is
Yeah,
it-
that would get you within a reasonable, say, 2-year lease up. That would get you up around $400.
Okay. If it takes longer than 2 years, then.
You're north of 400.
So you're not doing any spec building yet?
No, and we're not seeing much of that in our markets. There's building here and there going up spec, but usually there are known substantial prospects in the market when you see a spec building. But no, we're not seeing a lot of spec construction in our markets.
Yeah. Well, Jim, thanks for joining us today. We appreciate you being here in Studio One.
Pleasure to be here, Michael. Thanks.
Well, thank you. And be sure to join us next week. We'll be talking about Emerging Trends 2015. This is a great report. It's put out by ULI and PwC. Takes an interesting look at what's going to happen in 2015. Thanks for joining us this week. Till next week, be sure that you always lead, learn, and laugh, and join us for the Commercial Real Estate Show.
The Commercial Real Estate Show is brought to you by Bull Realty Commercial Brokerage, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive suite of powerful commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. Sozo Web Hosting and Cloud Solutions. Secure, reliable, and worry-free. Visit sozo.com. That's SOZO.com. FIU, Florida International University. Earn your master's in real estate online in as little as 10 months. Visit FIUonline.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. For more information on these great companies or for additional podcasts, videos, or blogs, visit creshow.com.